I'm 68 years old, and if there's one thing I need to tell you, it's this. Predicting market crashes is actually much easier than everyone thinks. It might sound a bit strange, but it's even simpler than predicting bull markets, because uptrends can continue much longer than expected with momentum, speculation, and irrational investor psychology. But bear markets mostly follow the same pattern. Imbalances that accumulate over time grow until they reach a breaking point and then explode massively. I've been running JP Chase for over 20 years, and I've managed through some of the most devastating market crashes in history. The dotcom bubble in 2000, the financial crisis of 2008, the flash crash of 2010, the European debt crisis, the pandemic crash of 2020, and in every single case, the warning signs were there months or even years before. The real problem wasn't that the signals were hidden. The problem was that many investors chose to ignore them. At JP Morgan, we built our entire risk management approach around identifying these warning signals as early as possible and positioning defensively before the crash becomes obvious to everyone else. We don't try to time market tops perfectly. To be frank, that's nearly impossible, but we can identify periods when the probability of significant market declines is much higher than normal, and during such times, we can position our portfolios to protect capital and even benefit from market stress. Those who preserve wealth during bear markets aren't the ones who predict timing exactly. They're the ones who recognize risky conditions developing slowly and gradually reduce risk before the majority panics. They're selling when others are still buying, raising cash when everyone is chasing yield, starting to build defensive lines when others are still talking about growth stories. Today I want to share with you the specific warning signals I monitor to identify periods when major market drops become significantly elevated. These signals have helped JP Morgan Chase not only protect our capital during crashes, but also enabled us to acquire distressed assets and strengthen our competitive position when our competitors were struggling. The first warning signal I watch is credit market deterioration. Just as credit market healing signals that market recoveries are coming, credit market stress shows that market declines are building. Credit markets are where the real economy intersects with financial markets, and they're often the first place where fundamental problems surface. When businesses start having trouble accessing credit, when banks restrict lending standards, and when corporate bond spreads start widening consistently, this is a warning that underlying economic conditions are deteriorating, and when economic conditions worsen, stock prices follow. Sooner or later, you can see this if you look at the period leading up to the 2008 financial crisis. Credit markets started sounding alarms as early as 2006. Subprime mortgage defaults were rising, banks were tightening lending standards, and credit spreads were starting to widen. Most investors didn't take these signals seriously because at the time, stock prices were still going up, but the stress in credit markets was a clear warning that fundamental problems were accumulating. The same pattern appeared before the dot-com crash in 1999 and early 2000. Technology companies were increasingly struggling to access credit markets except for issuing stock. Banks were getting nervous about lending to companies with no profitability and questionable business models. Credit spreads for speculative grade companies started widening months before stock prices peaked. At JP Morgan Chase, we monitor credit conditions constantly through multiple indicators. We track corporate bond spreads, particularly high-yield spreads relative to treasury bonds. We examine our own lending standards and the criteria applied by other major banks. We follow commercial paper markets, which are vital for short-term corporate funding. We analyze loan loss provisions and charge-offs across the banking system. To monitor credit market deterioration, look at high-yield credit spreads relative to treasury bonds. If spreads are widening, it indicates increasing credit stress. Monitor bank lending standard surveys conducted by the Federal Reserve. Pay attention to corporate bond issuance volumes and at what levels these issuances are priced. When companies start paying higher interest rates to borrow or completely withdraw from bond markets, this is a serious warning signal. Monitor commercial paper markets and money market fund flows. The second warning sign is monetary policy tightening beyond what the economy can handle. When central banks raise interest rates or withdraw monetary expansion, this eventually slows economic growth and pulls asset prices down. But the key is recognizing when monetary policy tightening becomes excessive aggressive relative to economic fundamentals. This process is more art than science because the full impact of changes in monetary policy on the economy takes months or even years, but there are certain patterns that repeat across different cycles. When the Federal Reserve rapidly raises rates, when they completely invert the yield curve by pushing short-term rates above long-term rates, when they start aggressively shrinking their balance sheet, these actions create stress in the financial system and eventually open the door to broader economic problems. There was aggressive Federal Reserve tightening before the 2000 dot-com crash. Fed Chairman Alan Greenspan at the time raised interest rates from 4.75% to 6.5% between June 1999 and May 2000. He was particularly concerned about stock market speculation and inflating asset prices. This aggressive tightening process also laid the groundwork for the recession and market crash that followed. There was also a Federal Reserve tightening cycle before the 2008 financial crisis. The dynamics were more complex, but the Fed raised rates from 1% to 5.25% between 2004 and 2006. These moves were one of the factors that lit the fuse of the subprime mortgage crisis, and the process eventually led to the broader financial system collapse. But the issue isn't just about what levels interest rates are at. It's about the pace of change and the alignment between monetary policy and economic realities. If the Fed is raising rates faster than the economy can handle, if real rates have risen too much relative to growth expectations, and if monetary policy is starting to significantly squeeze credit creation, this picture often comes before market declines. As J.P. Morgan Chase, we allocate serious resources to analyzing Federal Reserve policy, and we don't just look at what they're doing. We try to understand whether the steps they're taking are truly appropriate for the current economic picture. We closely monitor real rates, the shape of the yield curve, growth in money supply, and bank reserves. Let me explain how to monitor warning signals on the monetary policy side. Monitor the federal funds rate relative to economic growth rates and inflation. Track yield curve shapes, especially when short-term rates exceed long-term interest rates. Monitor changes in the Federal Reserve balance sheet and the growth rate of money supply. Pay particular attention to signs of rising concern about asset prices or economic imbalances in central bank communications. The third warning signal is excessive valuation levels seen across broad market segments. When stock prices rise far above levels that underlying business fundamentals can justify, it creates conditions where even small disappointments can trigger significant market declines. But observing high valuations isn't just about looking at price-to-earnings ratios or other simple metrics. It's about properly understanding the connection between current valuations and long-term economic expectations, whether current profit margins are truly sustainable, and understanding the appropriateness of current discount rates given monetary policy and economic conditions. During the dot-com bubble, many technology stocks were trading at absurd multiples of 50, 100, or even 200 times their earnings. That is, if they had earnings. It was clearly obvious that these valuations weren't sustainable, but investors believed so much in the new economy narrative that they ignored this situation in thinking classical valuation measures were no longer valuable. When reality surfaced, stocks fell 70 to 90% from their peaks. A similar picture was seen before the 2008 financial crisis. It wasn't very striking because it was happening in financial sector stocks rather than speculative technology companies. Even as banks' business models became increasingly risky and their balance sheets inflated with more leverage, their stocks continued to trade at historically high book value multiples. As J.P. Morgan Chase, we use multiple valuation approaches to analyze whether current market levels are truly sustainable. We examine traditional metrics like price to earnings, price to book value, dividend yield, but we don't stop there. We also evaluate more advanced analytical methods like enterprise value to EBITDA ratio, price to sales ratios adjusted for profit margins, and discounted cash flow models. If certain sectors or segments are becoming excessively expensive compared to others, we also pay attention to valuation dispersion. This mostly indicates that prices are being driven by speculation rather than fundamental analysis. During the dot-com bubble, technology stocks were priced at extraordinary premiums compared to value stocks. During the housing bubble period, home building and financial sector stocks were trading at excessively high multiples compared to more stable sectors like defense. Let me tell you how to track valuation warning signs, monitor cyclically meaningful broad market valuation metrics like Tobin's Q ratio and the ratio of total market capitalization to GDP. Also closely track sector rotation and relative value differences between different market segments. Pay attention to new issuance activity and EPO valuations, especially if even speculative companies with questionable business models or those that raise questions can go public at high valuations. This is mostly a sign that the market is climbing to its peak. The fourth warning signal is leverage extremes throughout the financial system. When businesses, financial institutions, and individual investors borrow excessively relative to their income or assets, even the smallest problems can turn into crises that spread system-wide. Leverage amplifies everything, both losses and gains. It makes everyone look smart during good times, because rising asset prices hide underlying weaknesses. But when a stressed period emerges, leverage forces selling at exactly the wrong time. This pulls prices further down and causes more forced selling. The 2008 financial crisis was fundamentally a leverage crisis. Investment banks were leveraged 30 to 1 or more. Homeowners were buying houses with no money down. Financial institutions were creating complex derivatives that multiplied their exposure to mortgage markets. When mortgage prices started falling, the leverage in the system amplified those losses until they threatened the entire global financial system. But leverage accumulates gradually over time, often in forms that aren't immediately visible. It shows up as increasing margin debt among individual investors, higher debt-to-equity ratios among businesses, more complex financial products with embedded leverage, and creative financing structures that allow people to control assets with less capital. At JP Morgan Chase, we monitor leverage levels not from a single angle, but across multiple dimensions. We regularly track margin debt levels among retail investors, corporate debt-to-EBITDA ratios across other sectors, bank capital adequacy and off-balance sheet risks, household debt-to-income ratios. We also track more hidden and indirect forms of leverage embedded in derivative contracts, structured products, and alternative investment vehicles. We pay extra attention to leverage in areas that could affect the overall stability of the market. If hedge funds are using significant leverage, if banks are rapidly expanding their balance sheets, if corporate borrowing is rising faster than cash flow generation, these trends mostly come before periods of market stress. Let me tell you how to track leverage warning signs. Monitor margin debt levels published by NYSE and FINRA. Track corporate debt-to-equity ratios and interest coverage ratios across different sectors. Observe bank leverage ratios and off-balance sheet growth. Pay attention to household debt levels and debt service ratios published by the Federal Reserve. The fifth warning signal is when speculative behavior and market euphoria get out of control. When investors start believing that classical risk management rules no longer apply, when the "this time is different" narrative becomes widespread, when speculation overtakes fundamental analysis, these conditions mostly signal market tops. Speculative behavior appears in many forms: surges in daily trading volume, explosions in options trading, meme stocks, and momentum trading take center stage in market discussions. IPOs and SPAC issuance reach extraordinary levels, and investors start borrowing money to acquire speculative investments. During the dot-com bubble, day trading became a cultural phenomenon. People were quitting their jobs to trade stocks full-time. Online brokerage ads suggested that ordinary people were getting rich through stock trading. The number of investment clubs increased, and financial media devoted enormous coverage to stock picking rather than fundamental analysis. The same picture repeated during the meme stock phenomenon of 2020 to 2021. Social media took speculation beyond what was seen in previous cycles. Individual investors were driving massive price movements in companies like GameStop and AMC, mostly based on social media posts rather than financial analysis. Options trading volumes reached record levels, and special purpose acquisition companies, SPACs, became one of the main vehicles for speculative investments. At JP Morgan Chase, we track multiple indicators of speculative behavior behavior. We monitor retail trading volumes and options activity, IPO and SPAC issuance levels, margin debt growth, and social media sentiment indicators. We also monitor our own client behavior for signs of increasing speculation or risk-taking. We pay particular attention to the quality of new companies going public and at what valuations they enter the market. When companies with questionable business models go public at excessive valuations, when SPACs proliferate rapidly, and when investment bankers struggle to find enough high-quality deals to meet investor demand. These are generally signs that speculation is overtaking prudent investment analysis. Let me tell you how to track speculative behavior, monitor retail trading volumes and options activity relative to historical norms, track IPO and SPAC issuance volumes and average valuations, pay attention to social media sentiment and meme stock activity, observe margin debt levels and retail investor survey data. The sixth and final warning sign is earnings deterioration and guidance reductions across broad market segments. While stock prices can remain elevated for extended periods despite fundamental problems, earnings eventually reflect underlying business reality. When earnings start declining across multiple sectors, when companies start providing negative guidance, when profit margins come under pressure, these developments mostly come before broader market declines. But you must distinguish between cyclical earnings, fluctuations, and structural earnings, deterioration. Every business cycle includes periods when earnings growth slows or temporarily declines. The warning signal comes when earnings problems become broad-based and persistent. You need to pay attention when companies start implying that the problems aren't just temporary cyclical pressures, but more serious challenges. Before the 2001 recession, technology companies started reporting disappointing earnings and reducing guidance throughout 2000. While stock prices remained near their peaks, companies that had been reporting explosive earnings growth suddenly found that demand for their products was slowing. Competition was intensifying, and their business models were less sustainable than investors believed. The same pattern was seen just before the 2008 financial crisis. Financial sector companies started reporting credit losses and reducing guidance throughout 2007. Even though stock prices weren't near their peaks until late in the year, banks started taking write-downs on mortgage-related investments. Insurance companies started reporting underwriting losses, and consumer finance companies started seeing higher default rates. At J.P. Morgan Chase, we closely monitor earnings trends in both our own business lines and the general economy. We regularly track the direction of earnings revisions, forward guidance trends, profit margin analysis on a sector basis, and leading indicators of business conditions such as employment growth and capital expenditures. We pay particular attention to earnings quality. We don't just look at whether companies are meeting expectations, but also how they are achieving this. When companies shift to more aggressive accounting practices, when they start relying on financial engineering instead of operational improvements, when their earnings growth becomes disconnected from revenue growth, these indicate that reported earnings may not fully reflect underlying business reality. Let me tell you how to track earnings deterioration, monitor consensus earnings estimates and revisions across major market indices, track forward guidance trends during earnings seasons, observe profit margin trends across different sectors, pay attention to earnings quality indicators like the relationship between earnings and free cash flow. Now let me explain how these 6 warning signals together prepare the ground for major market declines. Just as during rising periods, the riskiest moments are when multiple signals align simultaneously. The most devastating market crashes typically occur when credit markets are stressed, monetary policy is tightening, valuations are excessive, leverage is at extreme levels, speculation is widespread, and earnings are deteriorating all at the same time. The 2000 dotcom crash, the 2008 financial crisis, and several other major market declines all featured this convergence of multiple warning signals. But the critical point you need to understand is this: these signals don't tell you exactly when markets will decline or how severe the declines will be. They clearly show you when conditions are reaching a dangerous point and when the probability of serious market stress rises far above normal. When multiple warning signals emerge, the right response is not to sell everything and go to cash. What should really be done is to gradually reduce risk, strengthen defensive positions, and prepare for potential market volatility. volatility. This can mean reducing equity allocations, increasing cash reserves, avoiding speculative investments, and focusing on high-quality businesses with strong balance sheets. At J.P. Morgan Chase, we use these warning signals to guide our risk management decisions and the advice we give to clients. When we see multiple warning signals developing, we become more defensive in our positioning. We become more selective in our investment choices, and we focus more on capital preservation rather than growth. The most critical lesson I've drawn from tracking these signals for 40 years is that successful investing isn't about predicting market crashes with perfect timing. It's about recognizing dangerous conditions and positioning yourself to survive and thrive through whatever market environment emerges. Markets can remain overvalued longer than most people expect. Speculation can extend well beyond rational levels, and risky conditions can persist for months or even years before resulting in actual declines. But when multiple warning signs emerge, the wise investor prepares for possible volatility rather than assuming the current environment will continue indefinitely. The investors who succeed over long time periods aren't those who try to time every market move perfectly. They're the ones who understand market cycles, respect the power of these warning signals, and position themselves conservatively when conditions turn risky. They may miss some upside during the final phases of bull markets, but they preserve their capital during bear markets and position themselves to benefit from the opportunities that market stress inevitably creates. These 6 warning signals have served me well throughout my career, helping J.P. Morgan Chase navigate successfully through multiple market cycles and emerge stronger after every crisis. They're not perfect predictors, but they're reliable indicators of when market conditions are becoming dangerous and when prudent investors should become more defensive in their positioning.